Handout 1 for Chapter 10. This is my Chapter 10 summary, which will give you a very brief overview of both the accounting and the measurement or calculation that relates to each of the topics in the chapter. I have here two columns, one for the what I call generic journal entries, giving you the accounts or the type of accounts with no numbers, and on the right side here I'm giving you sample journal entries with actual accounts or sample accounts and sample numbers. I'll be talking a little bit about the asset purchase, which is the very first topic in the chapter. I won't be talking about A2, which is actually lump sum purchases. That will be, you have to rely on your book for that one. Topic A3, it will be the third subtopic in the first section of your textbook, which relates to the purchase of an asset. Then I'll go to the topic B, which will be depreciation, and here I'll be talking about straight line method as well as double declining balance method. And then finally, topic C will be disposals. So discarding a fully depreciated asset, discarding a partially depreciated asset, selling the asset, or exchanging it. So very quickly again, with respect to the purchase of an asset, as we already know, you're going to be capitalizing the cost of the asset. Any cost associated with getting the asset ready for use should be capitalized. So as you can see, that's what I'll be doing here, into some kind of property, plant, and equipment account. So it'll be a debit, and you're going to credit either cash and or a payable account. On the right side here, I'll give you an example. I'm buying a piece of equipment for $20,000, $5,000 in cash, and financing the rest with a note, $15,000. So you have a debit to equipment and a credit to both cash and note payable. Then in terms of capital expenditures, you know that there will be some expenditures that you incur for certain assets after you initially place them in service. So the question is, how do you treat them? So it depends on what kind of, what's the purpose of that expenditure. If you're going to be adding capacity to the original asset or making the asset better, more efficient, improving it somehow, then you're going to be adding it to an asset account again, if it's actually an addition or betterment, and you're going to hit either cash or a payable again. And so if it's, if you assume, for example, you have some kind of tool and you added some kind of function that makes it more efficient, or you added capacity such as maybe, it's faster maybe, then you're going to be adding the cost to either the original asset account. If it relates to equipment, you can just add it to the equipment account, or you set up a complete new equipment account, and you actually depreciate that amount over the remaining life of that same asset. If you instead have a expenditure that will lengthen the useful life of the asset, then you're not going to hit the actual asset account. Effectively, will come up with the same answer in terms of raising the book value, but you do it differently for extraordinary items. So extraordinary repairs. You actually hit the assets related AD account, which reduces it, and effectively that will increase the book value of the asset. So here, for example, I show you that if I spend $3,000 for the overhaul of an engine or the overhaul of a piece of equipment, and that will lengthen its life or extend the life of the asset, I will hit debit the AD equipment account for the amount of the expenditure, and that will again have the effect of reducing the AD account, which will also mean that it will increase the book value, so more to depreciate over the remaining useful life of that asset. If the expenditure doesn't provide with either more capacity or an improvement or more life, then it falls into just the category of regular repair or maintenance. In that case, you're simply going to have an expense. Actually, this is wrong. I'm going to switch it right now. It will be basically maintenance expense and then cash out. In terms of depreciation, the accounting itself is very simple. You're going to hit an expense account called depreciation, and you're going to hit the assets related accumulated depreciation account. Is a contra asset account. You do not hit the asset itself. You want to leave the asset's historical cost as is. To do that, you need to hit the accumulated depreciation account as shown here. An example would be here. You have a depreciation expense for, let's say, $4,000, and you're hitting the accumulated depreciation account for equipment in this example for $4,000. Now the question is, how do we come up with that $4,000? You use a formula. In the case of a straight line method, you're simply going to do cost minus residual value, your expected selling value, basically, of the asset at the end of its useful life. So the remainder between those two items, cost minus RV, would be the depreciable base, so depreciable cost. That's the maximum depreciation you'll take on this asset. So in this case, it will be $20,000. If you then apply the depreciation rate, which would be in the case of straight line, is 1 over its useful life. If it's 5 years useful life, it will be 1 over 5. 1 over 5 gives you 20% in this example. So 20% times the base will give you a depreciation rate per period or per year, in this case, of $4,000. Now, if the asset was placed in service, let's say in the middle of the year, so it's partial year, all you do here at this point would be just simply apply a proportionate amount to the per period amount. So if it's half a year, then we half of that $4,000 or $2,000 depreciation. Now the same accounting applies for double declining balance, but the calculation of the amount is very different. So in this case, notice that I'm using $8,000, and the reason that's different than straight line is because I'm applying a different formula for double declining balance. We start with cost again, but in this case, we're not using residual value. We instead are using beginning accumulated depreciation, which is 0. At the beginning, there will be no AD at that point. And so the beginning amount that we base the depreciable rate on would be the beginning book value. So 20,000 cost minus 0 AD beginning gives me a beginning book value of $20,000. Times 40% would be the depreciation rate. How is that possible? Well, it's because you'd use the straight line depreciation rate is 1 over 5 times 2, because it's double. So 2 times 1 over 5 gives you 20 times 2, 40%. So $20,000 times 40% equals $8,000. That will be the accounting you do for the first year. Now in the second year, I want to show you at least one more year to see how this works. The cost for the second year is the same, $20,000, but now we do have an AD balance from the previous year. So the beginning book value would be now $12,000. So that means that you have 40% applied to that. So the second year depreciation amount will be $4,800. You follow the same approach for the first few years, and eventually you will see that you cannot depreciate the asset more than the depreciable base anyway. So you have to come back to basically figure out that the depreciable base is still 20,000, because if you, I'm sorry, no, I shouldn't say that. That's not the right one. In this case, we don't have a residual value. We have a 0 residual value, but you cannot depreciate the asset more than its depreciable base. So you have to figure that out if there were, what would that be if there were residual value. But at this point, it will be $20,000 no matter what. Let's see. Let's move on. Make it quick. By the way, notice that there's also another method that is not in here in this handout. We call that the unit of production method, and that one you would find it under this link in a different handout number 2. So if you want to look into that, it's very simple. You just have to figure out what's the depreciation per unit and apply the number of units that you use the asset for in each period. So please review that in that other handout. Let's see, how about disposals? disposals are actually kind of the most challenging topic in the chapter. So let me start off with how do you deal with a fully depreciated asset? Well, in that case, there would be basically nothing left. And if you're discarding it, you're getting nothing in return either when you sell it. So basically, you're gonna simply just get rid of the asset account itself. So you're gonna have a debit to the related AD account for the asset and a credit to the asset itself. So at that point, you have 0 and 0 for both the asset account and the AD account. So giving you an example here, you have equipment that basically cost you initially $20,000. If you're not fully depreciated, you must have a total of $20,000 in the AD. So you're done. Now you don't need this because you have nothing in return, and you actually just simply get rid of it. Now, if you actually do have some kind of book value and you get rid of the asset, you would have a loss actually. So you would actually call this loss of disposal if that were the case. If you actually had a not fully appreciated, then that would be the case. So that's what you see basically here. You would have a loss right there. And so that when the book value is more than 0, meaning there's something left to depreciate, and you discard of the asset, then you would have a loss. So this will be how you would reflect it in the journal entry. In terms of selling, you would actually have the initial same accounts, debit and credit. You would debit the AD account. You would credit the asset account to get rid of the asset accounts themselves. Here's an example here. If you're getting rid of the asset when you have basically equipment costing $20,000, you have 3 years, so you have already depreciated the asset for 3 years using straight line, so you must have AD on the asset of $12,000, so you get rid of that, and you are gonna then sell the asset for $11,000. Then you're actually receiving $11,000, and at the same time you're getting rid of an asset that has a book value of $8,000. 20,000 minus 12,000 is 8,000, and you got 11. You must have a gain of $3,000. So when the book value is more than when the book value is less than the price that you have a gain, you would credit the gain. If you have a book value that is more than the price you're getting for the asset, you have a loss. You would have a debit instead of the credit to gain here. Finally, exchanges. This is a little more complicated, so I'm going to just be brief because I don't think I have to have a separate, presentation for this topic here. But generally speaking, you still have the same kind of initial steps here for accounting for the disposal through exchanges. You're going to be crediting the old asset and crediting the related AD account that gets rid of the old asset. You then book any cash you may have paid as well to obtain the new asset in exchange. If you do have the situation where you pay more, then you call that a boot. So you actually gonna have a credit for that cash, or sometimes you finance part of it as well. You would have a note payable, but just for now, just think of it as cash. And then you actually would book either a loss or a gain. Now there's some concept called commercial substance, and read the book. I don't want to get into it too much. Just to say that if it has commercial substance, then you would book all gains and all losses in the accounting for the transaction. If it has no commercial substance, then there's a different situation. You don't book the gains right away. You would book the losses no matter what. So again, that's a different topic. Look at the notes. And then finally, you would then book the amount of the newly traded asset, the one that you got in return for your old asset. So as an example here, you actually have again a piece of equipment that costs you $20,000, so you get rid of it. You have AD of that asset of $12,000. You apparently paid cash of $19,000. So you actually have a total book value of the asset here is calculated at 80,000. The price of a new equipment is 25. You're basically getting a trading value for your old asset of 6. So you're going to compare the book value to your trade-in amount. And this is something I'm just giving you at the moment, okay? It's just a given amount. So 8,000 is your book value. The seller gives you, or they'll tell you with which you're making a trade, gives you a credit for your old asset of $6,000. So the difference between those two will be $2,000 in you're losing. I mean, you actually have a bigger book value than the trading allowance. So that's when I have here is reflected a loss of $2,000. And finally, same sort of example here, except that in that case you get a TIA of 9,000, which gives you a gain. If you don't have a commercial substance, then you cannot book the gain. So that's why you don't see a gain in here. And so you're going to reduce the price of a new asset by the amount of the gain. And again, this last piece you don't have to really know that much about for this class. So you can probably disregard it if you wish. But at least get to know how to account for the disposals via discards, via sales, and then the one with just plain vanilla commercial substance. Enjoy!